So we have two main climate commitments. The first one was we wanted to be a carbon neutral organisation and achieve climate active certification. And our second climate commitment was we really wanted to measure our financed emissions, not only for our direct portfolio, but also for our indirect portfolio with our GPs. We knew that our Scope 3 financed emissions was really material, so we really wanted to get a handle on what that emissions profile will actually look like. We also know that although it's voluntary to report on this, we see that regulation actually coming to Australia within the next 18 months to 2 years. And the fact that we're a global investor, we've seen regulation kind of coming through the EU, the US, so we really just wanted to make sure that we stayed ahead of the curve from that perspective.
The broader community is interested in understanding how government and business look to make a positive impact on climate. From a ROC perspective, one, we're a regulated business and licensed in the financial services industry. We also have a fiduciary duty to our investors in regards to how we invest our money in an appropriate way.
We really look at the integration of ESG and climate risk in two broad buckets. So Lance already touched on kind of the risk and compliance lens, the fact that we have a fiduciary duty. If you're not considering climate risk into your investment portfolio, there's a huge risk that you are not considering your fiduciary duty as investors. But more importantly, if we consider the value opportunity creation, which is really where ROC sees a huge benefit of this process, is climate risk and decarbonisation has opened up a whole new investable asset class for us to consider. But also the fact that considering climate risk into your investment decision making can really actually help you achieve that positive upside or ESG premium that we're starting to see in the market. So when we consider investing in businesses, we need to think about what the exit plan will be and who will be able to sell that business to. You have risks of stranded assets, for example, but the more exciting side of it is to consider the ESG premium that businesses are actually acquiring if they have a genuine climate narrative.
What we're seeing is, with the change in the sophistication of technology and the tools that are being brought to the market by the global awareness of climate change, means that where we were integrating broadly ESG style risks into our investment decision process, we're now being able to be more sophisticated in the way we measure, report and mitigate that risk in regards to those portfolio companies and also those funds that we manage. We moved into engaging Path Zero to help us with that financed emission measurement problem that we're trying to grasp with in a private market space. And the technology solution that we've been working with Path Zero has been really important to us in progressing the way we measure and the way we report, not only for our portfolio companies, but importantly for our, what we call our fund of fund business, which is a primary market styled investing. It's important to note that ROC is not just your typical PE style business. The business actually invests across a whole different number of different businesses, but also has different ways to invest, and that's through direct investing or investing through a fund, which is what we call our fund of fund investing. And we've got a very large, diverse fund of fund style business, which is close to 240 odd GPs, and we have over 60 investment vehicles that we invest through. That complexity makes it quite difficult for us to work through all of those climate change discussions we need to have with those GPs to influence them in terms of how they operate those underlying portfolio companies that they are managing. That is an ongoing process for us to work through, and it is only with technology and the evolution of the measurements and guidance around those finance emissions that we are seeing really good traction in that space. Importantly, what we've found with Path Zero as a software and a system and process for us is when we're looking to measure a large diverse universe of general partners, as I mentioned before, 244 GPs that we need to look to measure from both a climate and a general ESG perspective. The importance of having a tool like Path Zero's Navigator is the consistency in the output we get, which enables us to compare those GPs in terms of where they are in their journey in regards to finance missions.
The Part Zero Navigator was developed in line with the Partnership for Carbon Accounting Financials, also known as PCAF methodology, and it was really important that we used a technology tool that was actually in line with best practice reporting standards. ROC will use the outputs of the Navigator in order to really drive down our financed emissions. The Navigator outputs helps us identify what our hotspots actually are, and we really want to use this as a tool for engagement with our portfolio companies and with our GPs. So we have some steps in mind as to how we will actually do that. So the first one will be really starting off that conversation, and then we'd like those companies, the portfolio companies or the GPs underlying companies, to undertake a baseline carbon assessment. Off the back of that, we would like a marginal abatement cost curve to be developed. So what that is really looking at different opportunities to reduce emissions and what the potential costs or savings of those opportunities will actually look like. We'd also like TCFD reporting. ROC is going to be undertaking TCFD reporting. We would want our portfolio companies and GPs to do the same. And then also really looking at appropriate net zero transition plans.
What we're seeing now with the evolution of climate change advocacy and focus across the industry and broadly the community is the evolution of these tools and sophisticated ways to measure carbon emissions. And that we see as being quite beneficial in telling the story in terms of how we've transitioned a portfolio company from being one which is maybe how it manages climate-related risks to now demonstrating where its journey has come from. That has enabled us to talk to value on exit, which we previously weren't able to do as explicitly as we can now.